Picture this. It's tax season. You open your notes, and you've got 52 wallets scattered across 6 chains, and you cannot remember which ones claimed which airdrop, or when, or what that token was actually worth the day it landed. That's not a hypothetical. That's the normal end state for anyone who's been farming airdrops for more than a year without a system. The wallets multiplied one testnet at a time, and nobody sat down on day one and said, let's build a record-keeping system for this. Today, I want to walk through exactly how that mess happens and what actually stops it from getting worse. I run proxy infrastructure and cloud phone farms for a living, and I treat airdrop farming the same way as an operations problem, not a lottery ticket. I'm not a CPA, and nothing in this video is a tax position for your specific situation, so don't take any of this as advice on what to file. What I can talk about is the operational side, because I've had to reconcile wallets at scale myself, and I've watched other operators try to reconstruct a year of activity from memory and screenshots in April, which is exactly the situation you want to avoid. Here's the thing nobody plans for. Most people who end up running 20, 50, or a couple hundred wallets did not set out to build a tax headache. They set out to qualify for airdrops across a handful of chains, and the wallet count grew one testnet and one new protocol at a time. By the time the first big claim actually lands, the paper trail is already scattered across a dozen different explorers, 3 or 4 wallet apps, and a handful of exchange accounts that were used to fund everything in the first place. The mess is already there before anyone notices it. So let's define the actual problem. Cost basis. Cost basis is the value you assign to an asset when you acquire it, and that number is what gets used later to calculate your gain or loss when you eventually dispose of it. If you bought something on an exchange, that part is simple. Your basis is roughly what you paid plus fees. Airdrops do not work that way because there's no purchase involved at all, and that's exactly where things start to get complicated for anyone running more than one wallet. The general treatment that most tax software and most preparers apply is that the token's fair market value at the moment you receive it, or at the moment you actually gain control over it, which can be a genuinely separate question depending on how the claim mechanism works, gets counted as ordinary income. That same value then becomes your cost basis going forward. Sell it later for more than that value, and you've got a gain. Sell it for less, and it's a loss. Simple enough for one token, one wallet, one claim, but look at what that actually means. Every claim event across every wallet you run is 2 things happening at once. It's an income event that needs a timestamp and a dollar value attached, and it's the starting point for tracking capital gains later. Miss the first part, and you've underreported income. Miss the second, and you cannot correctly calculate gain or loss when you move those tokens somewhere else. Do that across one wallet, and it's tedious but manageable. Do it across dozens of wallets, receiving dozens of different tokens at different times, and it stops being tedious and becomes a genuine data engineering problem. The failure point is almost never the tax math itself. It's the data collection underneath it. Say a token gets claimed in wallet 14 on a Tuesday, and the same token gets claimed in wallet 31 the following week. Those 2 claims can have meaningfully different fair market values at the exact moment of receipt, especially in the first few days after a token generation event, when price discovery is still volatile and moving fast. If you batch all your claims into one number because it's technically the same token, you throw away that accuracy, and you're building your basis on a number that was never actually true for most of your wallets. Wallets also get reused for different purposes over time, and that's another place the trail breaks. A wallet that started as a pure farming address sometimes ends up holding a claim token, then gets used on a different protocol, then gets bridged somewhere else, then gets swapped through a decentralized exchange. Every one of those steps can be its own taxable event, stacked right on top of the original airdrop income. And if you're not tracking it as it happens, you're relying on remembering a chain of 4 or 5 actions per wallet times however many wallets you're running. Funding wallets blur the picture even further. Most multi-wallet setups pull gas money and initial balances from 1 or 2 funding wallets, sending small amounts out to dozens of farming addresses. Those transfers are not income events, and they're not disposal events either, but they still need to be clearly distinguishable in your records from the actual claim events, or your whole ledger turns into noise that's impossible to sort through later. It sounds like a small distinction, but multiply it by every wallet you fund, and it becomes a real source of confusion. Urgent enough of all that, block explorers don't agree with each other. Etherscan style explorers, chain-specific explorers, and the transaction history built into your wallet app all label the same underlying event in different ways, and the CSV exports from each one have different columns, different timestamp formats, and different handling of internal transactions versus straightforward token transfers. Pull an export from 3 different sources for the same wallet, and you'll get 3 slightly different stories about what actually happened. None of this is exotic, by the way. It's the same reconciliation problem any business with dozens of bank accounts has to deal with. It just happens to involve more addresses and a lot less standardization between the tools tracking them. So the fix isn't some clever workaround. It's the same fix a business would use. Better bookkeeping habits, built earlier than you think you need them. The single highest leverage habit here is keeping a wallet ledger from the very start, not trying to reconstruct one after the fact. That means a running record, updated every time a wallet gets created. That includes the address, which chain or chains it's active on, which funding wallet seeded it, what date it was created, and what it's actually being used for. This does not need to be complicated. A spreadsheet with 1 row per wallet covers most solo operations just fine. The important part is that it gets updated as you go, not 6 months later. Point of this ledger isn't only tax prep either. It's the same discipline that keeps a multi-wallet operation legible to you. 6 months down the line, when you genuinely cannot remember whether wallet 47 interacted with a specific testnet or not. Clean separation between funding sources and farming addresses, plus a clear record of when each wallet was created and funded, serves 2 purposes at once. It makes tax reconciliation tractable, and it's just good bookkeeping for an operation with this many moving parts. And to be clear, none of this is about obscuring anything from a tax authority or from any kind of chain analysis. This is not a system for hiding wallet relationships. It's a system for you to keep track of your own operation accurately, so that when it's time to file, you actually know what happened instead of guessing. When it actually comes time to pull transaction history, exporting from each chain's explorer, per wallet, per year, is the reliable method. It's just slow. There are faster options through wallet software with built-in export features, or through address grouping views that some explorers now offer. But you still need to check that accuracy against the raw transaction list, especially for claim transactions that route through a distributor contract rather than a plain simple transfer. Whatever export method you use, the value that matters for tax purposes is the fair market value in fiat terms at the time of the transaction, not just the raw token amount sitting in the wallet. Explorers generally don't hand you this automatically for illiquid or newly listed tokens, particularly in the first few hours after a claim opens, which is exactly when most farmers are claiming. This is one spot where a professional or dedicated crypto tech software with real historical pricing data earns its cost, instead of reconstructing prices from memory or screenshots later. Crypto portfolio and tech software exists specifically to solve this multi-wallet reconciliation problem. And for someone running 5 or 6 wallets, it usually works fine. Connect the wallets, let the tool pull transaction history, categorize the events, generate a report. Done. The friction shows up once you're running at farming scale, not hobbyist scale. Most of these tools are built and priced around the assumption of a handful of wallets belonging to one person, not dozens of addresses that from the outside could plausibly belong to different people entirely. Import limits, per wallet pricing tiers, and rate limits on how many addresses you can add all become real constraints fast. And even with automated import, someone still has to manually confirm which transactions are income events, which are internal transfers between your own wallets, and which are genuine disposals. And that confirmation across dozens of wallets takes real time no matter which tool you're using. None of this is me saying one tracker is good and another is bad. What matters is going in with realistic expectations about how much manual review time you'll actually need, and picking a tool based on whether its wallet limits and export formats genuinely match the number of addresses you're running, not based on whatever the marketing page promises. It's easy to focus entirely on the airdrop claims themselves and forget that every swap, every bridge, and every gas payment along the way is potentially its own taxable event too. Bridging a token from one chain to another can count as a disposal of the original asset, depending on how that particular bridge works under the hood. Swapping a claim token for something else is a disposal. Even paying gas using a token that itself already has a cost basis, rather than a native asset acquired at a stable known price, adds another layer you need to track. Across dozens of wallets, that adds up to a large number of small events, most of which are individually trivial but collectively material if you leave them untracked. The practical answer is the same one that applies everywhere else here. Capture the event when it happens, tag to the wallet and the date, instead of trying to reconstruct months of scattered activity of an explorer at filing time. And none of what I've just walked through replaces an actual conversation with a tax professional who handles crypto specifically and understands multi-wallet activity, ideally someone familiar with how airdrop income gets treated in particular. Tax positions depend on your jurisdiction, on how a specific claim mechanism actually functions on-chain, and on facts unique to your situation that a general video like this one simply cannot account for. The goal of good wallet records was never to arrive at a tax position on your own. It's to hand a preparer a data set that's actually usable, instead of a pile of screenshots and a vague memory of which wallet claimed what 6 months ago. Keeping a clean, ongoing record from the start is genuinely the difference between a manageable filing season and a reconstruction project that eats your entire April. I farm these the boring, methodical way, and I write up what actually qualifies and how the operational side holds together. The full guides and the tools I trust are at airdropfarming.org. Full written guides and tested toolpicks are waiting for you at airdropfarming.org, so go check those out. And if this kind of operational breakdown is useful to you, hit subscribe for more.